Recessions come and go, but they often leave a bad mark on one's portfolio, which could take years to recover from, especially if the portfolio is unbalanced and more susceptible to market fluctuations and more heavily geared toward growth stocks. Recession-proofing one's portfolio is a strategy investors can use to reduce volatility in their returns, as well as provide continued stable income even during the worst of times while providing steady appreciation over time. The worst thing an investor could do is sell their assets in panic while the market is dropping, to then later purchase assets at higher prices, incurring heavy losses in the process. In this video, I will discuss the effects of a recession on investors' portfolio and how by employing simple strategies, an investor can recession-proof their portfolio while continuing to gain appreciation of their assets and get paid steady growing dividend income along the way, even during a recession. Check out the links in the description on a simple recession-proof portfolio that will appreciate over time and pay dividends along the way. By following these easy steps, one can make their portfolio recession-proof and substantially increase wealth during periods of uncertainty and prepare themselves to take massive action during recessionary periods to accelerate personal wealth. Get ready, you are now entering the Academy. In economics, a recession is a business cycle contraction when there is a general decline in economic activity. Recessions generally occur when there is a widespread drop in spending, an adverse demand shock. This may be triggered by various events, such as a financial crisis, an external trade shock, an adverse supply shock, or the bursting of an economic bubble. In the United States, it is defined as a significant decline in economic activity spread across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Recessions are cyclical in nature, triggered by one or a few of the events mentioned previously. Generally, a fall in demand could result in a fall in production, which results in a fall in employment as companies need to lay off people, which then results in more joblessness and therefore a fall in general available income for expenditures, which then results in a fall in sales, which further reduces production, and so on and so on. This results in a vicious cycle and a continual accelerated decline, which triggers a recessionary event. The last recession occurred during 2008 and 2009, when the financial crisis erupted, causing sharp declines in the stock market, where the S&P index dropped a whopping 37% from its highs. As can be seen in this graph, where the gray columns indicate all of the recessions within the last 60 years, based on probability models, the next recession is due approximately in 2020. The recession, or quote-unquote bad news, is in full effect by the mass media, as the loom and gloom prospects of a recession is starting to rear its ugly head. One thing to understand is that recessions are cyclical in nature and part of the economic cycle of expansion and contraction. As can be seen in this graph, there is a continual cycle of economic expansion followed by economic contraction over time. The peaks are moments of expansion when there is rapid economic growth. The stock market is at all-time highs, for example, where the troughs show an economic contraction is occurring, indicative of a bear market. The phases of the economic cycle have been occurring for the last 100 plus years and will continue to occur. This is the nature of long-term economic expansion. As can be seen over time, the long-term trend shows economic growth seen in the graph as a blue arrow. This is why over time, the S&P 500, for example, has significantly grown over the last 100 years and will continue to do so. Understanding the nature of the economy and recessions can be the greatest tool for a savvy investor. There are several investing strategies an investor can employ to navigate the waters of a recession, also known as recession-proofing one's portfolio. The first strategy is reducing volatility in their portfolio. To measure the volatility of one's portfolio against the market, one can use the beta of individual stocks to gauge volatility. During economic recessions, beta could be your worst enemy. The definition of beta is a measure of the volatility or systematic risk of an individual stock in comparison to the unsystematic risk of the entire market. In statistical terms, beta represents the slope of the line through a regression of data points from an individual stock's returns against those of the market. The entire market has a beta of 1.0. If an individual stock has a beta of 1, then this means that its price activity is strongly correlated with the market. During a recession, if the market is down, there is a large probability that an individual stock with a beta of 1 or greater will be down as well. An individual stock with a beta of less than 1 indicates its price activity is less volatile than the market. For example, utility stocks often have low betas because they tend to move more slowly than market averages. For a savvy investor, the first strategy is therefore creating a portfolio that is less volatile than the market with stocks that have low betas. A few examples of low beta stocks include Consolidated Edison, ticker symbol ED, which is a utility company with a beta of 0.09, The Southern Company, ticker symbol SO, another utility company which services in southern United States and with a beta of 0.18, Flour Foods, ticker symbol FLO, which is a company that makes various packed bakery goods such as Nature's Own, Wonder Bread, Dave's Killer Bread, and Tasty Cakes, with a beta of 0.42, Public Storage, ticker symbol PSA, which is a storage facility REIT with a beta of 0.17, American Water Works Company, ticker symbol AWK, another utility company with a beta of 0.14, and Church & Dwight Company Incorporated, ticker symbol CHD, which manufactures household products and is known for brands such as Arm & Hammer, with a beta of 0.15. These are solid companies that even under a recession keep producing and generating sales. They may not be glamorous, but they are defensive by nature, and even during the 2008-2009 recession, for example, they keep paying and growing their dividends. As noted previously, there are sectors that contain low betas in general compared with the rest of the market. The second strategy for the savvy investor is to diversify their portfolio across multiple industry sectors, asset classes, and regionally. A true well-diversified portfolio contains a healthy mix of fixed income assets such as bonds or cash, as well as stocks in diversified industry sectors with companies that do business globally for regional diversification. The industry sectors include financials, utilities, consumer discretionary, consumer staples, energy, healthcare, industrials, technology, telecom, materials, and real estate. Selecting individual stocks from each of these sectors limits one's exposure to any one group of sectors that may be declining, averaging out losses with potential gains in other sectors, thus minimizing overall losses. In addition to diversifying across sectors, focusing in on defensive sectors whose business models are the least affected by a recession historically because they provide essential goods and services that consumers continue to buy even during an economic downturn, can be added security measure to reduce volatility further. Historically speaking, consumer staples, healthcare, utilities, and telecoms have been the most recession-proof sectors. Their sales are least affected by the state of the economy since they sell essential products and services such as food, electricity, telephone and internet services, as well as medicine. The low beta stocks mentioned previously all fit into these defensive sectors. In addition, selecting stocks that have exposure to global sales diversifies a portfolio even further by limiting dependence on domestic business exposure, especially during recessionary periods. For more information on diversifying your portfolio, please check out my video titled Simple Investment Stock Portfolio for Passive Dividend Income. The third strategy is to invest in dividend income stocks that have historically grown their dividends over time above inflationary rates and consistently paid dividends over time. Most of these stocks can be found in the Dividend Aristocrats, which are S&P 500 index constituents that have increased their dividend payouts for 25 consecutive years or more. The Dividend Aristocrats' long-term track record showcases the long-term superior effect of compounding dividends as well as the positive effect of a rising dividend payout on a portfolio's total return over multiple year periods. Not only that, but during recessionary periods, Dividend Aristocrats tend to outperform other growth stocks, and dividend income continues to be paid out, sometimes with substantially increased dividend growth rates during these times. If dividends are reinvested during recessionary periods, dollar cost averaging at lower stock prices generates a compounding effect, increasing dividend income substantially, spurring massive wealth acceleration during these periods of uncertainty. For more information on investing in dividend stocks, please check out my videos titled How to Invest in Dividend Stocks, Wealth Creation Using Dividend Income, and my second video titled Recession-Proof Dividend Income, How to Prepare for a Recession 2020. Investing in a well-diversified stock portfolio with stable dividend income producing assets can be the smartest and safest investment for those looking to create wealth over time, even during recessionary periods. By employing the recession-proof strategies mentioned in this video, along with safe and smart investing techniques discussed in other 10X Academy videos, such as value investing, dollar cost averaging, dividend reinvesting, and diversification, one can create a low-risk dividend income flow that will grow over time and continue to pay income. Check out the links in the description on how to start investing in dividend income producing stocks, as well as a sample recession-proof portfolio you can start using to safeguard against recessionary periods while starting your path toward financial independence and freedom. Thank you for watching the 10X Academy channel. Please make sure to smash the like button if you enjoyed watching this video. It will really help out the channel and the YouTube algorithm for bringing more wealth creation strategy videos to the masses. And if you haven't done so already, be sure to subscribe to the Academy. And don't forget to turn on the notification bell to be alerted on more passive income strategy videos. This is the 10X Academy.